All right. Well, welcome everyone to tonight's session. And we're going to be reviewing the performance for November. And we'll start in a couple minutes, but let's wait till everybody gets into the room. We've got a lot of stuff to cover tonight to talk about what's going on, the performance of the portfolios, all the different things that are happening, the Fed meeting and inflation and markets and New Year's and what to think for 2023. Just want to say hi to everyone. I just got back from Benja Kitty Park, was walking and running there. It's such a beautiful park in beautiful Bangkok. Nirat Chara, good to see you. What's your view for 2023? We're going to get into some of that today. Which market that you keep an eye on or think it will outperform? Good questions, and we're going to look at those. Nan says, hello, Andrew. Hello, CPI day. Yeah, we're going to get our CPI numbers. CPI is such an interesting thing to think about what's going to happen next. I'm going to share some of my thinking on that here. Kunatip says, hello, John Andrew. Good to see you guys. I had speaking of John Andrew, I had a teaching the students at Chula where I taught a ethics course for finance. We had 95 students take the final exam. It was pressure for them. We had 50 ethics questions on the exam, and it was fun for me. Maybe not so fun for the students. Tiran Rat says, good to see you again. Kap Kunandu, yep, good to see you. And it is time to get started. Let me just make sure I've got my things set up here. 1 second. I think we're right here. Okay. So welcome everyone. And I'm going to be talking about strategy. And so why don't we get into it? I'm going to share my PowerPoint and let's talk about strategies and what's going on about markets updates and about weighting updates. Remember that already we see the first questions come in, and keep your questions coming. Just put them in the chat. I'll make a point of staying on until I've answered as many. And yes. And also I see Natapong says, Sawadee Krap, Kun Andrew, hope our December to be a positive. Yes, we want a positive December. My house is decorated with lights and a Christmas tree so that my mom enjoys a beautiful Christmas atmosphere, and we're having a lot of fun here at my house. So we're going to talk about all asset classes, and we'll talk about how they were all up in November. We'll review the performance. The all-weather inflation guard was up 0.9%. All-weather strategy was up 4.2%, and all-weather alpha focus was up 4.4%. Global outlook that guides our asset allocation. We'll go through that. And then new weights in our strategy. Before I get started with that, I just wanted to talk briefly about the way I think about investing. And one of the key things that I think about when I am considering investing is set a good structure, have a good system in place, and stick to it. And that's the whole thing that I hope we're bringing to Phenomena, to you guys, to everybody there, that this is I've spent a decade working on building this structure called FVMR, and also rebalancing on a quarterly basis and not overreacting with markets. And today I'm going to show you one chart. I want you to think about this because we're going to get to that chart later. And that is part of the job that I see of what I'm trying to do with strategy is to figure out how we can reduce some of the variability without reducing too much of the return. The idea being is that when investors are panicking, I'm not, you're not, we're following a systematic methodology. So Anucha says, thank you, Dr. Andrew. Following your update, I was able to secure gold around 1660. This gold is still good. I'm considering adjusting to 20% of my portfolio. I think gold still has potential, particularly if the dollar starts to fall. If the dollar starts to weaken, then gold should do well. Also, if equity markets fall in the new year, then gold does well. I would say 20% in a portfolio is a pretty high amount. I would say that's just depends on your own situation, but 20% is high. I actually go to 25%, but I consider that to be really high. Yeah, Santa Claus is coming to the stock market. Let's see. All right, so world stocks have taken a hit in 2022, but gained in October and November. And here, this chart, I look at stocks, bonds, commodities, and gold. In 2021, world stocks were up 19%. So where are we now? We're almost ready to close out the year, and stocks were down only about 15%. It wasn't an absolute disaster of a year. The market recovered on expectation that central banks will slow rate hikes. I think most people are starting to think that the Fed's going to slow now. Now, bonds were up slightly in November. Remember that bonds collapsed, at the beginning of the year because interest rates started shooting up. But that's already factored into the price. In all-weather strategy and all-weather alpha focus, rather than global bonds, we had a target allocation to the Thai money market, which was flat as expected, as you see in that blue line. The main purpose of our money market allocation is downside protection. Our commodities funds were up slightly in November, and gold gained 6% in November 2022. So it was, Anucha, not a bad thing to be in gold. And Saranat says, does all-weather strategy must be maintain equity in Japan, Europe, and US? Yes, with all-weather strategy, well, again, I think I would like to talk to you directly about this. Part of what can help make our performance stable and help us to not panic is that we don't want to over focus our portfolio too aggressively in one way or another. One way to do that is to provide some minimums. So in the case of each of our Japan, Europe, emerging markets, Asia, and the US, those are our 5 allocations to equities. For each of these, we maintain a minimum of 5% in them. So we'll never go below 25% for equity. That just prevents us from getting crazy. Like, you know how when you get panic and you think, I'm going to take all my money out of stocks, or I'm going to take all my money out of bonds or gold or whatever. We don't want to panic like that. And that's the reason why we have minimums set up. All right, back to the PowerPoint. So gold closed the month at $1,768 per ounce. Now, it's key to understand that a weaker US dollar was the main driver of gold's performance. They're moving in opposite directions. All right, so let's start with our low-risk strategy, all-weather inflation guard. This is a strategy that you wouldn't expect to have huge ups or downs. And in fact, what we can see is that since we launched this in July, it's on par with a 40% equity, 60% strategy since inception. The strategy was about 0.1% above this 40-60 as of the 9th of December. Keeping in mind, this is also after fees, but doesn't consider sales charges or front-end fees. So this is after fees. While the return was on par, our strategy experienced less volatility. You see how the red line was just kind of flat across, whereas the 40-60, 40% equity, 60% bonds fell more than that. So that is exactly what we're trying to do with this lower risk strategy. Provide something that provides some stable long-term return, not huge, but with less volatility. So let's review the November performance. The strategy was up by 0.9%, but 2.5% less than the 40-60. So in that case, what happened, you can see all the way to the right, we can see some world energy damage. And the global equity fund we use in the strategy had a weak performance in the past months, which led to underperformance. Sometimes we have active funds, sometimes we have passive funds. That one didn't do that well. Now, gold's strong performance was offset by world energy's poor performance. Let's now look at all-weather strategy, which was up 4.2% for the month of November. It's been above the 60-40, 60% equity, 40% strategy since inception. The strategy was 6% above the 60-40 as of 9th of December, 2022. So let's review the November performance. Here we can see the strategy was on par with the 60-40. So it's neck and neck. Let's review our 25% allocations. Well, gold did well. We had 25% there. Commodities and bonds were flat. So we protected our downside, which is what we're trying to do with bonds. And then commodities, we got a little pickup. So that gives you a picture of what happened there. So now, and also keep in mind, if you see that Asia Pacific ex Japan did really well at 15% up, keep in mind that we're not aggressively tilting most of the time in this strategy. So let's now look at where we do have real aggressive tilts. That's the all-weather alpha focus, which was up 4.4%. So here we can see that it's above the 60-40 portfolio since inception. And that's about 0.8%. Again, that's after fees. Now, this chart shows it against the 60-40, and now this chart shows it against world equity. Part of what we're trying to do with Alpha Focus is to be more aggressive with equity and trying to reduce the risk. And we did that. If you look at that green line, the typical person that would have just gone into equity would have been on a roller coaster ride and only be up to 83.3. But with our strategy here, in this case, we were on less of a roller coaster ride, and it happens to be up above the world equity. So since inception, the strategy was 7.6% above world equity as of 9th of December, 2022. So let's review the November performance. Here we can see the strategy was 0.5% above the 60-40 portfolio, and the strategy was 2.8% below world equity. So world equity was a great rebound. World equity rebound, and our bigger tilts to healthcare and bonds were a drag on our performance in this period. Now, a lot of people have asked us to try to show the different strategies compared to each other. And here you can see the strategies are performing pretty much as expected. The low risk strategy is the AWIG, the green line. And you can see it's just kind of flat across the middle, and it ends up at about 99. The moderate risk one is all weather strategy, which went down and then came back up. So there's a little bit more volatility. And then our most aggressive strategy was the all weather alpha focus AF. And for that strategy, we had much more volatility, and we managed to outperform the other two strategies. Now, we would like to see the all weather strategy, the red line, above the green line. But for right now, it's doing okay. I don't have a problem with that. So we started AWIG in July. So the period of comparison is short here. AWAF has had the highest return and volatility, just as we expected, because of its risk that it's taking on. And AWS and AWIG have returned about the same, but AWIG had a lower level of volatility. Now here we just bring in the world equity into it, the dotted line, and all strategies had a much lower level of volatility than world equity. And remember, when I started tonight's presentation, I said that there's a chart I'm going to show you. This is a chart that I'm thinking about to help you to see that if you just went into world equity, you would have been on a roller coaster ride with that dotted line going down a lot. And now you would have ended up right where we are at about 99 for all weather strategy. And the point in this case is that part of our objective is to try to smooth out the investing. And we do that through gold. We do that through bonds. We do that through commodities. And by doing that, we hope that when you feel panic or frustrated, that you can look at the strategy and say, this strategy has not been in a panic mode, and therefore we're not having overreactions to what's happening in the market. So AWAF, Alpha Focus, is 4% above world equity and has had lower volatility. AWS and AWIG have returned the same as world equity, but at lower volatility. All right, let's look at the global outlook that guides our asset allocation. That was a review, a performance review of the past. So now let's look forward. Let's talk about equity. Inflation continues to be through the roof. This is a calculation that I do that is a weighted, take each country's GDP and then calculate that size of that country's GDP relative to the global GDP, and then multiply that times the inflation rate in that country. And therefore, we get a weighted inflation rate for each country. We sum that up, and that's the red line. And what we can see here is that it continues to rise at about 8.8. And I would say that global inflation still remains high. But I don't think that the US inflation is going to be acting like this. And I think eventually it's going to come down. Higher prices at some point reduce demand. And a higher base effect is also likely to reduce the inflation rate going forward. So inflation could be close to a peak, even without central bank intervention. Now we got the Fed meeting soon. And right now, a December Fed hike is priced in. What we can see is the market is pricing in 100% certainty of another Fed rate hike at the next FOMC meeting. The implied probability is 75% for a 0.5% increase. So 50 basis points increase, and only 25% for a 75% increase. So here, what we can see is since March, market expectations have shifted to a much more aggressive Fed. We were meeting in March and we were looking at that curve, which was down at 2 to 2.6. Well, things have changed pretty significantly. The market expects that the target rate will peak in about, let's say, the middle of 2023 or a few months before it in May. The Fed is aggressively tackling inflation, which raises the risk of causing also a massive recession. Now, the problem is when you think about inflation, if we want to, somebody may think about, say, Andrew, what's more critical to the Fed, a recession or high inflation? The answer is, number one, the Fed's mandate is really inflation. If they don't tackle inflation, they're not really doing their job. So that's the first thing that you can say, the Fed is focused on inflation. The second thing is that when economy goes into a recession, some people are hurt very hard. They're hit by job losses, business closing, but not everybody is hit. Some people do well, and some people just hang on to their jobs throughout the recession. So you could say it's a small number of people that are affected from a recession. But when it comes to inflation, everybody's affected. So the answer is, if you ask me what the Fed is focused on, the Fed is going to be focused on inflation. And therefore, they're probably going to tank the economy. All right, let's go back into the presentation. And here you can see that the market expects, what the red line here shows the change in the US Fed's target rate. It went from basically 0 to about 4%. And consensus shows us that it's going to be that dotted line, and it's going to peak at 5% in May of 2023. Currently, market participants are betting on this peak between March and July coming. So you could say after first quarter. Considering the weighted probabilities, the peak rate is expected to be May. Now, the Fed has kept the peak rate, target rate for 6 months on average since the 1980s. Here, what you can see is the final part of this chart. The final part of this chart shows the average. What you can see is the increase. Let me grab my pen so that I can show you. Hold on. Doing that right now. I see Mom Dangerous. And she says, hello. Hello, Mom Dangerous. All right. So what you can see is this is the current increase that the Fed has done. And this is what the market's pricing in, a peak. And if we assume that they stay at 6 months for a peak, that's what it's going to look like. Now you can see the slope of this line is very steep, steeper than any other situation that we've seen. So during the dot-com bust, the Fed kept the peak rate at the peak for 8 months. And during the global financial crisis, they kept the peak rate for a record 15 months, which is a long time. So based on the 6-month average, we would expect that the Fed will pivot in September, and then they'll start to come down. Now that's excluding some major event that could come. So the next question is, are we in for a recession? The answer is yes. The yield curve inversion is diving deeper. Every time, basically all recessions in the US since 1970 were preceded by an inverted yield curve. That means that short-term yields on government bonds are higher than long-term yields. The average time from this inversion, which means going below that line of zero, from inversion until the recession started was about 1 year, which basically means we should be in a recession in about 6 months. And again, that's about the time that the Fed will probably start to pivot, unless there is some kind of major crisis. Let's look at valuations for a minute, because valuations are critical for stocks. The valuations have come down primarily due to a price fall. You can see the PE ratio is the red line, and the PE over on the left side, if I go to the top of the red line right here and I go all the way over to the left, we can see that the PE was about 20 times. And now if we look at where the PE is, let's say it's about 14.5 or so is where the PE is right now. So that's a considerable de-rating that's come down. However, what you can also see is that earnings have barely fallen. In most crises, you go back to the 2008 crisis, you can see earnings collapsing, this blue line collapsing quite a bit. See, during the COVID times, collapsing. Here, we haven't really seen a collapse. So I think it's still possible that equity could fall further. Or let's say profit margins will fall further. EPS forecast will fall further. And when it does, it'll be negative for the market. But eventually, it'll be the bottom. So world stocks valuation is now slightly below its long-term average, but I think that we're going to see a downgrade. So while the consensus net margin has come down a bit, there's been no significant downward revision. So one of the ways we can understand this is we can look at the consensus EPS estimate. And if we look at 2022, this year, analysts are forecasting 6%. That's the red bar. Now, previously, analysts were forecasting growth here, and now recently they have downgraded that, and now they think it's from 7%, they've downgraded down to about 4%. So that's what they're expecting right now. So really, part of the question becomes, what's going to happen with earnings? Now, I think that analysts are very slow to change, and what we may have is even negative earnings growth in 2023, and then we get down to the bottom of the cycle. Analysts expect 6% 1 year ahead growth in the US, slightly lower earnings in 2023, and then 10% earnings growth in 2024. What about Europe? Well, Europe has an exceptionally high earnings growth because it's bouncing back in 2022. But also that's going to mean that it is going to be down almost to zero for 2023. And here we can see amidst every region forecasts a lower EPS growth. Now we can see everywhere. Now, what is interesting is we can look at Asia and say either analysts covering Asian companies are really overly optimistic and earnings is going to come down to here, or it could be that Asian markets have already taken their hit, and therefore this is a realistic assumption. And if that's the case, you could say that Asia Pacific, excluding Japan, looks interesting. Now, it's especially worrisome for U.S. stocks. Note that analysts are overly optimistic and they fail to foresee market turns. Now, for the past year, we've said that we think the course will eventually be reversed. We still think that central bankers and politicians will change course and return to accommodative policies as soon as something breaks, meaning the Fed reduces interest rates. And we do think that central bankers are going to break things. Central bankers may kill growth, but not inflation. That would give us stagflation. That would be bad. Stagflation is typically bad for both stocks and bonds. Commodities have typically done well during these inflationary times and have been resilient during stagflation. And gold has historically fared well during stagflation. Let's talk about bonds. Bonds are typically a safe place to be, even though 2022 has been exceptionally bad. In recessions, safer assets like government bonds are typically going to perform well. And though with high inflation, lower yields could still lead to negative real returns. We typically don't allocate to bonds to speculate on the upside, but rather to use it as a way to protect capital over time. Let's look at commodities. The market expects natural gas prices to rise during the winter in Europe, and we're seeing European natural gas prices rebounding massively. It's cold and it's dry and it's not windy in Europe, so they're not getting wind power. They're not getting solar power to the extent they normally would in the summertime. So European natural gas prices have bounced back, and Europe's Russian gas dependence influences prices. And if the weather gets colder, gas storages can quickly deplete and prices will rise further. There is fundamental support for energy prices. OPEC Plus keeps missing its output targets, and the cartel has announced to cut production and support oil price. The Ukraine war could lead to a further supply shock, and energy prices can also remain high due to past underinvestment in new projects. Here we can see the supply for agricultural commodities could tighten further. Right now, it's kind of sitting at 136 for the index. The supply for agricultural commodities could tighten further, and La Nina should reduce the supply of important commodities like corn, soybean, and wheat. Commodities have some fundamental support, right? Demand for necessities like food and energy, inflation, and supply chain disruptions related to and unrelated to the war in Ukraine are going to keep commodity prices high. And a reopening of China could lead to increased demand for commodities, but it could be a while away. Let's see. Also, if we were to go into a stagflationary period, commodities should show resilience. This really is what commodities are all about, is to protect you in a high inflationary period. And I just want to mention, if somebody came to me and they said they want to invest in commodities for their long-term portfolio, I would generally say, don't do it. Why? Because commodities tend to perform a lot like stocks. You don't need to complicate it. But since I can be a little bit more complicated, I'm able to allocate to commodities, and I do. But really, the time that commodities adds value to the portfolio is only at the times when we have exceptionally high inflation, or if we had stagflation. It could be maybe 12 to 18 months, and that's commodities don't provide performance for many years after that. Why? Because commodities are not an income producing asset. So that's just a little bit about my view. We'll go back to the presentation and let's continue on. So next, we're going to talk about gold. This is an interesting chart. We can see that central banks have been loading up on gold, maybe switching from US dollars. And this is the annual purchase or gold demand. And we can see it's very, very high. And we put in a little estimate of what we think it would be for fourth quarter, and that gets us to 782 million metric tons that have been bought. Now, we keep gold as an insurance policy. The war in Ukraine spurs uncertainty, and inflation expectations could rise, making gold attractive. And though expected rate hikes are negative, in general, gold protects value in market downturns. So what are the key takeaways? Central bankers appear to be raising rates into a recession to stifle inflation, and stagflation would be the worst outcome. Demand for necessities like food and energy, inflation, and supply chain disruptions can drive commodities higher. It's a really difficult call right now because we're kind of stuck in the middle of a slowing economy, maybe inflation coming down, and bonds and gold are there to protect capital. All right, it's time to announce our new allocations. Ladies and gentlemen, drum roll, please. Let's talk about all-weather inflation guard, our low-risk strategy. Here we can see is that we keep equity at 30% and we reduce tips slightly. We move 5% to world healthcare and world infrastructure, and we consider both of them defensive, but healthcare has been more defensive this year. So a very small change, but part of that change tells you that we're not so convinced that inflation is going to be a big problem in 2023. So when you ask me about my opinion for 2023, one thing I would say is that inflation will be coming down in America. Now, outside of America, it's a little bit of a different situation. It's harder to bring inflation down, but in America, inflation I expect to come down. Now, we reduced the inflation-linked bonds to 10% from 15%, and we raised Thai medium-term bonds by 5%. Thai inflation looks like it might have peaked, just like U.S. inflation. So we reduced the inflation-linked bonds to 10% from 15%. So what's the risk? Well, the risk is that rate hikes pushing down bond returns. We're mainly exposed to Thai bonds. Hence, the Bank of Thailand's actions impact the most. And central banks' aggressive rate hikes and QT could crash markets. That would be bad. And collapsing energy prices would be damaging since we have an exposure through our 5% allocations to world energy and commodities. All right, time to look at the new weights for all-weather strategy. And here you can see we've made no change. We remain underweight equity and keep 25% target weights in each asset class. Our FEMR model is telling us to remain defensive. And we can see now we still have a 25% allocation to the stock market. That is very low. We can go up to as high as 85%, but we did not. So no change there. Within equity, we have a 5% minimum asset allocation to each region. As I mentioned, we have these to protect us from overreacting. We do keep a minimum there. So what's the risk here? Well, inflation quickly gets under control. Central banks' aggressive rate hikes and QT crash the markets. That could be significant. We're underweighting equity. So if central banks pivot and stocks go up, we miss the upside. Weak Chinese economy could reduce commodities demand, leads to lower prices. And other commodities could fall with energy prices too. So it's a part of the production cost. All right, let's look at all-weather alpha focus. And I think we're getting close to be able to take your questions. We increase our equity allocation to 73% from 63%. So this is interesting because our model here for the alpha focus is more aggressive, and we are able to be more aggressive. We've increased world energy and we've added India. We've reduced healthcare and infrastructure, and we've gotten out of the U.S. We only had a 3% weighting in the U.S. Now we do have a weighting in the U.S. through the world 25% allocation that we have to the World Fund, but this gives you a picture. We've reduced bonds to 2% and gold to 3%. So we are getting aggressive outside of bonds and gold and the U.S. And we raised commodities to 22% from 4%. Now let's talk about our 22% tilts. We've already covered commodities and talked about energy prices, but let's look at one more chart related to our 22% tilt to world energy. This is interesting. Look at this chart. What does it show? That KTAM World Energy Fund, which has an underlying ETF to it, is outperforming while S&P crude prices are falling. And what does it show? The energy sector can perform well even if oil prices don't rise. That's partially because oil prices are elevated, and that supports energy companies' profit margins and potentially new investments. And recently concluded COP27 indicates that gas investments are set to continue. Now, Indian stocks have held up well in this year's turmoil. We think India can outperform the world stock index, so we have a 22% target weight. India is poised for continued growth, where Indian tech companies and infrastructure investments should be important drivers. The new Indian government budget is focused on infrastructure, renewables, and healthcare, and the spending is to continue to support fast GDP growth. This continued budget deficit also should instill confidence that the government is supporting the market. So the risk to the strategy is that global recession could push down stocks. Central banks' aggressive rate hikes and QT could crash stocks, and we've just increased our exposure to equity. Collapsing energy prices would be damaging since we have high exposure through our 22% allocation to world energy and commodities. The strategy has a 22% tilt to the Indian market, so the strategy could be negatively impacted if the Indian market were to crash. All right, before we get to the Q&A, we have the Valuation Masterclass Bootcamp number 7 starting on January 9th, 2023. Getting excited for it. Our limited super early bird price is still available, and with a phenomena coupon code, you can save $100 extra. Get an extra $100 off any price point until December 20th. You're going to save about $800. Just scan that QR code and use this coupon code phenomena and go to valuationmasterclass.com/bootcamp. So it's time for Q&A. Now I'm going to stop sharing my screen a little bit, and I'm going to sit down because I stood up a little bit, and let's go through and try to answer some of the questions that you guys have asked. I just want to say there's 187 people that I see on the YouTube. I want to welcome everybody. It's about 7:40 right now, so we got about 20 minutes or so that we'll be able to go through all the questions. So I'm going to go back up to the top of the questions and see what was the first question. The first question came from Nirachara, and it says, good evening. What is your view for 2023? Which market do you keep an eye on that you think will outperform? Well, I think that now you can see for my all-weather strategy, I'm 25% stocks, 25% bonds, 25% commodities, and 25% gold. That basically tells you that I'm underweight equities in that strategy. And what I would say is that I also believe that inflation is going to come down and interest rates will also come down, particularly in the US. And so ultimately, bonds do pretty well in that type of an environment. All right. Yeah, it's CPI day coming out. Let's see. Let me look. Make sure you put any questions that you have. All right. So there was a question from Anucha about the gold, and I would say it's not a bad allocation, 20% for gold. Right now I have 25%. I think you just have to be careful because gold is not necessarily a great performer over the long run, but it protects the downside. So if that's what you're concerned about, that's good. And I think dollar's eventually going to start to come down. And when it does, gold will perform. Okay. Soranat says, does the strategy maintain the equity in Japan, Europe, and US? And I tried to explain earlier that we have 5% allocations to prevent ourselves from going crazy. Little Panda says predictable, which I wasn't sure exactly what that was referring to. Maybe I'm predictable. Asia looks interesting indeed. Is Vietnam included? Asia is interesting and Vietnam is interesting, but for right now, if you don't see Vietnam in my portfolio, it means I don't see it as attractive right now relative to, let's say, in this case, India and other options that we have to buy. When you see Vietnam come into the strategy, then you know I've turned positive. So Anucha says, so regionally, Europe and Japan seem interesting as big rebounds on earnings, and Asia seems defensive as earnings may be stable. I think that's reasonable. One of the questions is, how long is Europe going to kill itself? If they keep doing stupid policies, it could be that the recovery in earnings doesn't happen until second, third, fourth quarter of this year. But I would say that that's reasonable assumptions. All right. Can you explain about stagflation scenario? Salaya says, and yesterday I was at Salaya to go to a wedding last night. When will it happen and how long will it stay? What will happen all over the world? Okay. So stagflation basically means that inflation stays high, but the economy is collapsing. And it's not a situation that can stay for that long. Why is that? Well, because stagflation means inflation's high. But when you see that things are expensive, what do? You stop buying. You start replacing expensive things with cheaper things. And when companies see that products and services are expensive, what do? They produce more of them. And so you have a market reaction that tries to balance supply and demand. So I wouldn't make a bet that inflation is going to stay high for that long. Now, it's different when you think about emerging markets. Let's talk about Thailand. Thailand, basically, the problem is that the Thai economy, basically, ultimately, the decisions by Thailand are related to the currency. They may raise interest rates to protect the baht and prevent it from devaluing relative to the dollar. And they may decide, no, we want to print money. But if they start to print money, then what they'll have is they'll start to have some inflation, and then the Thai baht will be hit again. And what we could see in a country like Brazil, where Brazil increased its short-term interest rate by up to like 36%, I can't remember, it was a crazy number. They increased their government short-term interest rate massively. And they did that partially because they have to protect the currency. And so in that case, they're going to slow down the economy. They're going to strengthen the economy, the currency, and also they're going to slow down inflation. And that's what's happening. All right, let's see. Nan says, what's the difference between stagflation and recession? And what should we invest in both those regimes? So when you have a recession, it usually means that demand is falling and things are slowing. Think about in 1997, Thailand, in 1998, after the 97 crisis, Thailand's economy crashed by almost 11%. That is almost a depression, but let's say a depression is something that's deep and lasts for a while. A recession tends to be a short-term thing. But now let's just look at that and say that we had a short-term collapse in the economy, right? That's a recession. And nobody can raise prices when the economy is down like that. And employees can't ask for a raise because they already know it's a very tough time. So we typically see a recession also including a collapse in inflation. Inflation down when the economy's down. So it's a very rare situation when the economy's down and inflation is up. Now it can happen, such as supply chain damage that we've seen, where the economy could collapse and the cost of goods continues to skyrocket. So there's a lot of different factors, but that gives you a picture of what I think, how to understand inflation versus recession. Will value stocks outperform growth in 2023? I don't know, because what's happening is growth stocks are collapsing so hard that there's probably no choice but for value to outperform growth. So I think it's very possible that value stocks outperform growth. Ben's Plant says, hello, John Andrew. What's your view about U.S. and China? What is the most concerned issue between U.S. and China? My concern is that the U.S. wants to go to war with China. And I think that they want to beat China as soon as possible. They're doing it in many, many different ways, but the Defense Department already has concluded that China really is the main threat to America. So this is a big concern for me. And it's definitely going to impact business, and it's going to impact investing in China. We don't have any investments right now in China because it doesn't look attractive on an FVMR basis, but I have my concerns. China will be fine itself because it has an internal demand that's pretty good, but it may be that China can't participate as much in the global market. Just take a look at the latest China exports to America. Those exports are down 25%. And with America trying to hold back the highest technology chips, as an example, it's just going to hurt China. And I think that there's some issues there that I'm concerned about. And that's part of the reason why, again, China's not in the strategy right now. AJ, which one do you think will perform well, short term or long term? It's a good question. I would say if my scenarios come true, the US stock market and stock markets in general will probably drift down over the next 6 months. But I also expect that something could go wrong. The property market could collapse or bond yields could collapse. And if that happens, then the Fed may pivot and start to inject money in, and then the market would go up. So I don't know if I've got a great answer for that right now. Narong says, what are your opinion about Asia Pacific zone? Actually, I think that a lot of the opportunity now is in Asia Pacific, for sure. First of all, China's just too risky. So Southeast Asia, to me, looks like a reasonable investment for a typical investor around the world. So that's the first thing. I think that US and Europe are going to be preoccupied. Also, I think the problem in Asia, because only Japan has a fiat reserve currency, they're the only countries that could lower their interest rates so low, yet not dramatically depreciate their currency only till recently. If Thailand was to, let's say, try to pump up the economy and the market by reducing interest rates and pumping money into the hands of Thai people throughout the pandemic and after, what would have happened was that investors would have said that the Thai baht is going to devalue, and they would have attacked it. So the free-floating currency brings the market's perspective to that country, and it's a good check and balance for a country. But because almost every currency in Asia is free-floating, it means that they never could really print a lot of money. They couldn't save the people. They couldn't provide as much as the developed countries. Now, when times were really bad, that was a disadvantage, and developed countries were able to flood their economies with money. But now in Asia, you could say we've been through a lot of pain, and therefore we may be at the bottom or even past the bottom. So it looks interesting to me. King Kong says, do you have any advice to new investors who want to investment during an exciting situation in the coming year? Well, I think that my first advice, and this comes from my podcast, my Worst Investment Ever podcast, I've interviewed more than 650 people about the mistakes that they've made. So I think you've asked the right person, King Kong. I think the first thing is to set a long-term plan. The second thing is to realize that you won't get rich in the stock market. You may say, John Andrew, that's the whole reason why I'm investing is to get rich in the stock market. No, what I want you to do is separate the concept of creating your wealth from the concept of growing your wealth. The stock market is where you grow your wealth. you create your wealth either through your salary or your job. Get your wealth engine going well, right? Between your salary or your job, and then use that money that you're making and invest that in the market with the idea that you're going to invest for the long term. So for you, King Kong, maybe a moderate strategy like the all-weather strategy is a good place to start. Now you say, but I want to trade in the market. Okay, fine. Take a portion of your money and trade and see how it goes. But for a beginner, I would say start with all-weather strategy. Okay, yeah, Narong had asked previously, I can't remember the question now. The question that Narong asked, hold on one second. I can't find it. Anyways, so let's continue and say, KT, is it still a good idea to use past data to predict return of assets? Market keeps inventing new financial tools in recent years, such as credit default swaps, QE, crypto. KT, I think this is a really good question. And in some ways, you could say it's kind of a theoretical question also. But I would say, Warren Buffett's famous for using a 10-year average past EPS. And he takes the average of earnings over the past 10 years. That means throughout different cycles. And then he looks at the price relative to that past earnings. Now, he's also calculating the future in his head and thinking about that, but he uses past data. And I would also say, that we have a good saying in English, which is the more things change, the more they stay the same. And I would say from my 30 years in the market, I wouldn't pay too much attention. All of the different financial tools and swaps and all those things, I would stay away from them and I would just focus on the overall market. And my answer to your question is that generally the market is going to follow past behavior. It's going to be on big booms and big crashes. And it's going to have a range of returns of maybe, let's say on average, 5 to 10%. So I would argue that it's more important to understand exactly where you are relative to the past. And once you understand the past really well, then that helps you to think about the future. So I guess my answer to that question, KT, is don't be fooled. Things are actually not that much different today than they were in the past. All right. Nan says, you cut infrastructure, healthcare are not good as defensive. Well, infrastructure right now is just not acting defensively. Healthcare is acting more defensively, and that's the reason why I decided to get out of the infrastructure. And Montri says, Sawadee krap, good to see you. All right, let's look at the next one. Pawn says, since many of the FANG man has dropped quite a lot this year, which of them do you think still is a good investment for the mid to long term? So all of these tech stocks have completely collapsed this year. And I would say from my perspective, the one that looks most interesting to me, Amazon. I just think that Amazon has a business model that will just keep growing and growing and growing. And so if I had to choose one FANG, that's the one. The second one that I would buy, it's not really a FANG, but I would buy Twitter. Now you may say, oh, Andrew, wait a minute. Warren Buffett took Twitter private. It's not traded in the stock market. My prediction is within 12 months that he will list Twitter again on the stock market. And hopefully it's priced reasonably well. And I would think that that would be a very good buy because he's cut the cost down and made the company profitable. All right. Anucha says, thanks so much. Such a wise advice going wealth and creating wealth. Yeah, that's something I've learned over the years. We create, grow, and protect our wealth. And that's what I say. Yeah. So did I say Warren Buffett bought Twitter? I actually meant to say Elon Musk bought Twitter. All right. I think that's it. I want to thank everybody for attending tonight's session. We had a lot of people and some great questions. And I want to encourage you to ask questions to your phenomena representatives or any others. You can also ask questions to me. And if you've got questions about how to invest, go to your advisors. They've got great advisors at Phenomena, and get support from them. And ultimately set a system and follow the system. I want to thank everybody, and I hope that you have an amazing night tonight and a relaxing night with some good food and also great sleep. Thank you, and we'll see you in 1 month.